Hello everyone, welcome to the 139th episode of me learning how to trade in Forex. So in the last episode we looked through what is risk management. Basically a key part to successful trading is to ensure you manage your risk properly, because as any trader who's been in the game for long enough will know, you can't get it right every time. So in finance, risk is defined as the potential for the actual return on an investment to be lower than the expected return. So risk management is a set of rules and measures you can put in place to ensure the impact of getting a decision wrong is manageable. And then we look through the type of risks there are. So there's three main types of risks you can come across when trading. We've got market risk, which is basically the possibility you will suffer losses due to movements in the market price. And then we look through the four factors that have the greatest impact on market prices, so interest rates, stock prices, foreign exchange rates, and commodity prices. And then we look through, and then the other main type of risk that will come across in trading, liquidity risk. So this is the risk that you can't buy or sell an asset quickly enough to prevent a loss. There are two main types of liquidity risks. So there's asset liquidity risk and funding liquidity risk. And then the final one is a systemic risk, which is basically the risk that the entire financial system will be affected by a particular event or series of events. So these could include natural disasters, war, major political or regulatory change. And then we went through lesser summary. So now we're on to ways to manage risk, part 1. So ways to manage risk, part 1. Date is the 18th. So ways to manage risk, part 1. Now we've looked at the main type of risks to keep an eye on, we can concentrate on how to manage those risks. Always be aware of the downsides. Before you place every trade, you should calculate exactly how much you stand to lose in the worst case scenario. Remember that sometimes the market can move quickly or gap, meaning you might not be able to get out of your trade at the level you wanted to. You need to keep the worst case scenario in mind, because if there's a major market event, you may be overly exposed. This is particularly important to remember when placing leverage trades, where your losses could be greater than your deposit. How to manage risks. Always be aware of the downside. You should calculate how much you stand to lose in the worst case scenario. Before you place every trade, you should calculate how much you can lose in the worst case scenario. Remember that sometimes the market can move quickly or gap, meaning you might not be able to get out of your trade at the level you wanted to. Note that the market can move quickly and gap, meaning you might not be able to get out of your trade at the level you want it to. You need to keep the worst case scenario in mind, because if there's a major market event, you may be overly exposed. So keep the worst case scenario in mind. As if there's a major market event, you may be overly exposed. This is particularly important to remember when placing leverage trades where your losses could be greater than your deposit. Avoid emotional trading. Whoops. When making trading decisions, you should distinguish between those which are rational and those which are emotional. When making trading decisions, you should distinguish between those which are rational and those which are irrational. Oh, emotional, not irrational. Relying on a gut feeling will almost certainly end in disaster. Relying on gut feeling will almost certainly end in disaster. So it's vital to back up your decisions with clear analysis. As we've seen earlier, creating a structured trading plan can help you manage emotional risk by providing clear guidelines and helping you maintain your discipline. So it's vital to back up your trading plan with back up your trading decisions with clear analysis. Creating a structured trading plan can help you manage emotional risk by providing clear guidelines and keep you disciplined. Diversify. If you often have more than one position open at any one time, you can help minimize risk by putting your money into a broad range of different investments. In other words, not putting all your eggs into one basket. For example, if you put all your investment capital into the shares of a single company, you risk losing it all if that company goes bust. On the other hand, if you buy shares in many different companies, your losses from the one that fails won't have such a devastating effect on your overall investment. However, even spreading your capital across a range of different shares can't protect you from systemic risk factors that can affect the stock market as a whole. Therefore, the best way to diversify is to spread your investment across asset classes. For example, you may end up having a portfolio made up of shares, commodities, property, bonds, and other investments. These markets often move independently of each other, providing protection against one particular asset class underperforming. Put your money into a broad range of different asset classes. So e.g., this is the i.e. your portfolio could include shares, bonds, commodities, properties, etc. These markets often move independently of each other, providing protection against one particular asset class underperforming. Yep. Select riskier investments carefully. Put your money into a broad range of different asset classes. Wait, as they often move independently from each other. So this provides protection against one particular asset class underperforming. Select riskier investments carefully. If you do end up having a portfolio of different investments, it's sensible to balance out any particular risky investments with more stable assets. The investment risk pyramid is a handy model to help you decide how to spread your risk across various financial instruments. So, top middle base, higher risk / potential profit as you go up the pyramids, cash, savings accounts, government bonds and annuities, middle shares, property, investment funds, high-end in bonds, high-income bonds, futures, options, CFD, spread betting. Balance out any particular risky trades with more stable assets. The investment pyramid. Whoa. More stable assets. Most traders will probably want to keep the bulk of their investments in safe assets that provide regular, if unspectacular, returns. These are represented by the pyramid's base. In the middle, there are medium risk assets, which should provide a stable return and have a potential to appreciate. At the top are the higher risk investments which have the potential for huge returns but large losses too. The money you put into these high risk assets should only be money that you can afford to lose without serious financial repercussions. Of course, the pyramid acts as a guide rather than set rules, so you need to think carefully about the amount of time and money you have to invest and the level of return you want to achieve when choosing which assets to trade. Most traders would probably want to keep the bulk of their investments in safe assets that provide regular but low returns, which are represented by the pyramid's base. The higher risk investments at the top should only be money that you can afford to lose without serious financial repercussions. Of course, the pyramid acts as a guide rather than set rules, so you need to think carefully about the amount of time and money you have to invest, and the level of return you want to achieve when choosing which assets to trade. Okay, listen summary. You can't control whether a market goes up or down, but you can control your risk, so it's vital to have an effective risk management strategy in place. To manage risk effectively, you should always be aware of the maximum potential downsides, avoid emotional trading, diversify investments, and select riskier trades carefully. Ways to manage risk, part 2. Ways to manage risk. Part 2. We've looked at some general methods of managing your risk. Now here are 2 practical techniques you can use to work out exactly how much risk you should be taking on with each trade. 2 techniques to calculate how much risk you should be taking on per trade. Calculate your maximum risk per trade. Choosing how much to risk per trade is all about your personal circumstances. You'll find some guidance that says don't risk more than 1% of your trading capital per trade, while others say it's okay to go up to 10%. Most traders agree not to go much higher than that though, and here's why. If you go on a big losing streak, the amount you're losing per trade will have a huge effect on your capital and the ability to claw back your losses. Say you've got $10,000 of trading capital, and you're lucky enough to lose 15 trades in a row. Here's the difference between risking 2%, 5% or 10% per trade. Starting capital, so 2% gets you about 7.5 grand, I think that says. 5% will get you about 4.5 grand. 10% will get you about 2 grand. So yeah, with a 2% risk per trade, even after 15 losses, you've lost less than 25% of your trading capital. It's conceivable that you can win this money back. However, if you've gone for a 5% risk per trade, you would have lost over half your initial trading capital. You have to do more than double this amount to get back to your original level. With 10% risk per trade, things are even worse. You'll be down over 75%, making it extremely difficult to make back the money you've lost. Whoa. Just put this diagram here. This is a really clean diagram. Damn. The reduction of capital after a series of losing trades is called a drawdown. So, drawdown is the reduction of capital after a series of losing trades. It's important to work out what percentage of drawdown will make it difficult to reach your trading goals. So what percentage of reduction of capital after a series of losing trades will make it difficult to reach your trading goals, and then ensure your maximum risk per trade is in line with that. Calculate what percentage of drawdown will make it difficult to reach your trading goals, and then ensure your maximum risk per trade is in line with that. Based on this information, you can also work out a risk per trade scale. If you're an active trader who only places a few trades every day/week, then the scale might look like this. Type of risk, percentage of total equity. More than 20% reckless. More than 5% high risk. 2 to 5% medium risk, 1 to 2% low risk. Of course, if you're a long-term investor only making a few select shares of trades per year, then 10% risk per trade might make complete sense. But if you're a high frequency forex trading making over 100 transactions per day, then even 2% per trade could be far too high. It all depends on you and how you like to trade. So make a risk per trade scale. So like that. The percentage will depends on the percentage the percentage all depends on you and how you like to trade. Remember, all traders will be affected by a losing streak at some stage. All traders know that all traders will be susceptible to a losing streak at some stage. But the ones who plan their trading to cope with those streaks are usually more successful in the long run. So therefore, plan to cope with those losing streaks. So therefore, plan to cope with those losing streaks. Work out the risk versus reward ratio of every trade. Calculate the risk versus reward ratio of every trade. It is possible to lose more times than you win, yet be consistently profitable. It's all down to risk versus reward. To find the ratio on a particular trade, simply compare the amount of money you're risking to the potential gain. So if your maximum potential loss on the trade is $200 and the maximum potential gain is $600, then the risk versus reward ratio is 1 to 3. So risk to reward risk versus reward ratio is the amount of money you're risking for the potential gain. If, for example, you place 10 trades with this ratio and you were successful on just 3 of the trades, your profit and loss figures might look like this. Profit, loss, 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 profit, loss, 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 profit, loss. Overall, still $400 profit. Very nice. Over 10 trades, you could have made $400, despite only being right 30% of the time. That's why many traders like to stick to a risk-reward ratio of 1 to 3 or better. A word of warning though, if you're taking on a less risk for a greater potential reward, it's likely the market will have to move further in your favour to reach your maximum profit than it will to hit your maximum loss. So in the example above, the market will probably have to move 3 times as far in your favour to reach a $600 profit than it would have to move against you to cause a $200 loss. Less risk for greater reward. Note that if you're taking on less risk for a greater reward, for a greater potential reward, it's likely the market will have to move further in your favor to reach your maximum profit than it will to reach your maximum loss. So basically, the market will have to move with a risk to reward ratio of 1 to 3. The market will have to move 3 times as much to hit your profit target than it would to hit your loss target, or its stop loss target. Say you buy 100 shares of Citigroup at $27 each, but you don't want to risk more than $400. At which price should you place your guaranteed stop loss? 100 shares, so that's 27 times 100, that's 2,700. 2,700, you don't want to risk more than $400. Wait, so let me just get my calculator out. 2,700, you don't want to risk more than $400. Minus 400, 2,300 divided by 100 shares, 23. As you purchase 100 shares, if the price of Citigroup drops $1, you start to lose $100. To make sure you don't lose more than $400, you need to place your guarantee stop loss $4 below the current price at $23. Okay. So, lesson summary. Always calculate your maximum risk per trade. Generally, risking under 2% of your trading capital, your total trading capital per trade is considered sensible. Anything over 5% is usually considered high risk. Work out the risk versus reward ratio of every trade. It is possible to lose more times than you win, yet be consistently profitable. Many traders like to stick to a risk to reward ratio of 1 to 3 or better. So, generally, risking under 2% of your total trading capital per trade is considered sensible. Anything over 5% is considered high risk. Many traders like to use a reward to risk ratio of 1 to 3 or better. Okay, choosing your trading style. Choosing your trading style. One of the reasons trading is so popular is it can be carried out in a variety of different ways to suit your personal preferences. As well as choosing to trade the markets that interest you, you can also pick a trading style that makes the best use of your skills and fits your personality and lifestyle. When we talk about different trading styles, we're basically referring to how often you place a trade and how long you keep those trades running. Trading styles refer to how often you place a trade and how long you keep those trades running. So your style of trading will be strongly affected by how much time you can commit and your attitude to risk. Your trading style will be strongly affected by how much time you can commit and your attitude to risk. For example, if you think you can spend several hours a day sitting in front of a computer studying charts and market trends, then you may find you're suited to making a large number of short-term trades. But if you're a very busy person and can only afford to spend around 30 minutes per day researching the markets, then you'll probably be more comfortable placing just a few longer-term trades. Your personality will also have a big influence over your trading style. If you enjoy trading for the excitement and the buzz, you'll be more likely to enjoy short-term trading. If you're calm and patient, you may prefer to sit back and monitor your trades over the long term. With that in mind, there are 4 main trading styles to choose from. The 4 main styles. 4 main trading styles. Position trading or investing. Swing trading. Day trading. Scalping. So position trading or investing, time frame, long term, holding period, weeks, months, years, trading activity low. Swing trading, time frame, medium term. You know what? Just to make this easier, copy. There we go. Why was I clicking like 10 different buttons? Position trading. Swing trading. Day trading. Scalping. Okay, so position trading or investing, time frame long term, holding period weeks, months or years, trading activity low. Swing trading, time frame medium term, holding period days to weeks, trading activity medium. Day trading, time frame short term, holding period intraday, so within a day, trading activity high. Scalping, very short term, holding period seconds to minutes, trading activity very high. We'll take a look at each in more detail over the next 2 lessons. So, lesson summary. A trading style describes how often you place a trade and how long you keep those trades running. Your style is usually determined by your personality, attitude to risk, and the amount of time you can commit to trading. Your personality, and your attitude to risk. Cool. So, position and swing trading. Position and swing trading. Position trading. Position trading involves holding position for weeks, months, or even years with the expectation it will become profitable in the long term. Trading involves holding positions for long periods, hoping they'll become profitable in the long term. Investing is the most recognized and traditional form of position trading, with a great many people holding long-term investments in share portfolios, funds or pension plans. However, investing exclusively refers to going long, while position trading can include going short as well. Before entering a trade, a position trader will often spend a considerable amount of time studying the fundamentals of the asset they're going to be trading. Before entering a trade, a position trader will often spend a considerable amount of time studying the fundamentals of the asset they're going to be trading. For example, when buying shares, you usually look at the company's financial reports and in particular the financial statements to see if it's making profit or has an edge over its competition. Similarly, if you're position trading on Forex, you'll probably examine the economic health and monetary policies of the relevant countries before placing a long-term currency trade. Because of the long-term nature of these transactions, position traders tend to risk a lot more per trade than other types of trader. Because of the long-term nature of these transactions, position traders tend to risk a lot more per trade than other types of traders, though the expectation of making greater profits, which means to be successful you need to have patience and not get spooked by short-term market moves. To be a successful position trader, you need patience and not be spooked by short-term market movements. If you decide to follow a position trading approach, there are a few things you need to be mentally prepared for. When holding a trade for a long time, it's almost inevitable that the market will move in an unfavorable direction at some point. In these circumstances, you need to have the resolve and conviction to follow the rules set out in your trading plan. Wait for the market to turn back in your favor if required. When holding a trade for a long time, it's inevitable that the market will move in an unfavorable direction at some point. You need to have the resolve and conviction to follow the rules set out in your trading plan. But imagine if you were then to read comments in the press suggesting the market could move even further against you. Would you be able to hold your nerve? What's more, if trading using leverage, you need to make sure you have enough starter capital to weather any large unfavorable price swings. As trades are made over such a long time frame, the market could easily trend against you for several days or weeks. Even if it does end up reversing eventually, these moves could force you to close your position early if you don't have enough capital in reserve. To wait for the market to turn back in your favor. If trading using leverage, ensure you have enough starting capital to weather any large unfavorable price swings. As trades are made over such a long time frame, the market could easily trend against you for several days or weeks, even if it does end up reversing eventually. These moves could force you to close your position early if you don't have enough trading capital in your reserve. True or false? Position traders like to open and close many different positions in the same day. False. Position traders usually hold trades for much longer than one day. True or false? Position traders usually prefer to use charts rather than study the fundamental data behind whether a market rise or fall. False. Position traders regularly use fundamental analysis to trade. True or false? Position traders are often independent thinkers, able to make educated guesses about future market movements and stick by them. True. Correct. Position traders need to be extremely patient and strong-willed. True. Correct. Okay, swing trading. Swing trading involves holding positions over several days or weeks in an attempt to take advantage of medium-term market movements. It involves holding positions for medium periods, hoping to take advantage of medium-term market movements. It's the ideal style for people who want to trade fairly frequently but don't have the time to spend all day monitoring markets. Ideal style for people who want to trade fairly frequently but don't have time to spend all day monitoring the markets. In fact, it's entirely possible to have a full-time job while swing trading in the evenings or early mornings, although you must be careful to set stops and limits for each trade. Nice. Swing traders will regularly hold positions overnight. Regularly hold positions overnight, where large movements and market gaps can occur. Large movements and market gaps can occur. Due to the length of time trades are held for, the market will often move in an unfavorable direction at some points. Therefore, a certain amount of patience and nerve is required, though not as much as for position trading since the time frame per trade is shorter. Due to the length of time the trades are held for, the market will often move in an unfavorable direction at some point. Therefore, a certain amount of patience and nerve is required, though not as much as for position trading since the time frame per trade is shorter. Both fundamental and technical analysis, the study of market movement using charts, are commonly used for swing trading. Fundamental and technical analysis are used for swing trading, with technical analysis particularly used for establishing stop and limit levels. Technical analysis especially useful for setting stop and limit levels. True or false? Swing traders need to keep their eyes on the market fairly consistently throughout the day. False. Swing traders often only check the market a few times per day. Swing traders don't mind holding positions for several days at a time. True. Swing traders need to know whether they're right or wrong about trading immediately. False. The medium-term movement of a market is important to swing traders, not how it behaves immediately. Swing traders like high-speed action-packed trading. False. Swing traders generally like to take their time, placing only a few trades per day/week. Did you know market gaps occur when the price of an asset makes a sharp jump from one level to another without any trading in between? So market gaps occur when the price of an asset makes a sharp jump from one level to another without any trading in between. These tend to occur between trading sessions. Market gaps tend to occur between trading sessions. For example, if the closing price of an asset one day is significantly higher or lower than its opening price the next. Market gaps can be caused by earning results, geopolitical events, regular buying/selling pressure of any major news announcements with the power to move the markets. They often occur in equity and commodity markets, but are rare in Forex since its high liquidity and trades 24 hours a day. So market gaps can be caused by earnings reports, geopolitical events, regular buying/selling pressure, or any major news announcement with the power to move the markets. Market gaps often occur in the equity and commodity markets, but are rarer in Forex since it's highly liquid and trades 24 hours a day. And I've got a nice little photo of what showing a market gap looks like. Cool. So lesson summary. Position trading involves holding position for weeks, months, or even years with the expectation they will become profitable in the long term. Swing trading involves holding positions over several days or weeks in an attempt to take advantage of the medium-term price market moves, and market gaps occur when the price of an asset makes a sharp jump from one level to another without any trading in between. Good. Alright, I'm going to leave this episode here then. So, in the next video, we're going to go through day trading and scalping. So, thank you all for watching, and I will see you guys in the next video. Bye bye.